Welcome. How are you doing today? Welcome to my podcast here, and we're going to jump right in. Appreciate you jumping on this channel. If you're here and you're not watching the live stream, then I definitely recommend or let you know that I'm live streaming pretty much every day, sharing people with my experience with people going through the probate process in Durham County, North Carolina, um, and it's really this is designed to help folks who are personal representatives who are in charge of managing the estate find ways to navigate the process in a more efficient, smooth way. And one of the main ways that I'm able to uh, keep the doors open and fund my lifestyle, basically run the business, the way the business makes money, essentially, is my clients or the folks I work with don't pay me. Quite often, there is property involved in these transactions in a probate case. Quite often, because probate is the legal process of settling the debts and distributing inheritance, and the largest asset usually in the estate is the properties or is the property. Often, the estate will want to sell it so they can get inheritance or pay off debt, and sometimes a selling it on the traditional real estate side is not a viable option. For instance, there may be times when someone doesn't have enough money to actually sell, and we're going to talk about today. So we're going to talk about how you can still get a fair price for your property by having your buyers follow a particular strategy that a lot of people know about, but actually a lot more people don't know about. But I wish even more folks did know, because it's one of the ways that just really help people in so many situations. It really creates a win-win-win for all. So let's take a look. So how can you get a fair price and have a buyer pay your monthly mortgage payments? In a typical transaction, there's usually a mortgage lien on a property. Most people aren't buying the properties all out cash. It's awesome if you're able to do that. Depending on what your strategies and your purposes are, it may be really beneficial for you to do that. It may be beneficial for you to leverage, but regardless, whatever the value of the property is and the difference in that amount, that's called equity. So let's say you have a property is worth $100,000. Keep the numbers simple. It has a $50,000 mortgage lien on it or loan on it. That difference is $50,000. So there's $50,000 in equity in that property. Let's say the same property is worth $100,000 still, but now there's a $150,000 mortgage on the property. That means that there is a negative $50,000. The property is underwater, negative $50,000. And many of us find ourselves in that situation, particularly if we bought property at a time where everyone was able to buy, and then the market may either goes down or you refinance. There's so many reasons why there may be lack of equity in the property. And so taking payments over, having someone like a professional home buyer take over your payments is a great strategy if it fits your needs. Okay. Here's a caveat. I'm not a financial advisor. I'm not an attorney. Don't play one on YouTube channel. I am simply sharing my opinion, and definitely want you to take heed to that. Line 503 in the HUD, the Housing Urban Development Statement, right there. Existing loans taken to subject. So this is the buyer side, and it shows you how are they buying the property. Are they paying off the first mortgage? Are they paying off the second? Or are they 503 taking over loans taken subject to existing loan? All right. So this means that you are so 203 on the seller side too. I didn't know it was parallel to that. That's awesome. I'm gonna start looking at that. But this means that the seller or the buyer is now responsible for the monthly payments, but the loan stays in the seller's name. So why would the seller want to do that? Well, one, the seller is relieved of the monthly mortgage payments. They no longer are responsible for also the maintenance or the insurance and the taxes. This is all because the deed is actually given over to the buyer. It's their responsibility now, and the mortgage payment is going to be paid off when the buyer refinances out or resells. Well, I guess refinance is a resale, is a refinance. But regardless, these are some of the benefits to the actual seller. Now, the buyer, obviously, they come in at a lower entry rate, which allows them to avoid the banks, avoid the underwriting that can go even when you're doing a traditional sale. You have to go through underwriting. There are a lot of checks that have to be crossed and things of that nature. This completely eliminates that. Now the buyer has the responsibility of monthly payments and taxes and insurance, and the buyer is now able to use the funds that she or they would have used in the acquisition to adding value, whether it's rehab or whatever their thing they're going to do. And then that allows them to go in. Now the property is at a higher value and they're able to refinance, resell, kick out the old loan and move forward. And folks are happy. Now, make sure you have a real estate attorney to ensure that the transaction is done properly. And again, please note, just like in any other, sometimes a person be aware of this strategy and so you may hear, no, you can't do this, as opposed to I don't know how or I've never heard of this. So I highly recommend that you do ask around. It shouldn't take you too long because many real estate attorneys will know about this. However, again, there's some folks that don't. And yeah. Also note that, well, we'll talk about this in a few moments, but a licensed third-party note servicer is often used to make sure that everyone's on the up and up when the monthly payments are being made. All right, so let's see. Why would someone agree to this, though? Like, why would someone agree to keep the loan in their name and give the deed away? And this is a transaction I've had the chance to do maybe 8 or 9 in the last 2.5 years. In fact, I literally just got off the phone with a seller that I've been speaking to for 2.5 years. And I don't try to force the strategy onto them. I just want to make sure that it has to fit the right need. And so she felt that, hey, the property, there's not enough equity. I really need to move on and I need relief from this the monthly payment. So we're going to move forward and I'll probably get a contract in the next couple of hours. But anyways, why would a seller agree? Well, one, seller might be behind on payments on their mortgage payments. So they want that relief. They want to know that someone's coming in who has a business model that's tried and verified and to take over those payments. Another thing is, again, there's not enough equity. And they want to sell. So you have to satisfy somehow. You can still sell this way and guarantee that the equity or the old loan will be paid off based on the deal structure. And you may have additional mortgages. So you may want someone to step in and perhaps there's 2 liens or 3 liens on there and take on one of the mortgages there so that provides some relief or several so they can provide relief. What are the risks involved in the subject to existing loan? Let's see. So we have one risk is the loan getting called due to acceleration. That's often called the due on sales clause. And to be just quite frank and honest, in the transactions I've done and even the coaching that I've been a part of and the mentors who have worked with me, the bank wants to make sure that they're getting paid monthly. They're not in a real estate property management business. They want to make sure they're being paid every month. When we do this, we sit down with the original note holder and the bank and let everyone know what's going on. So we can also know how we want to set those monthly payments and ensure that they're actually going to the bank and not to the seller. So that's one thing. But also, please note that when we do buy the property, when someone just to ensure, or when someone does buy the property to ensure protection, it is recommended that you buy it in a trust or the person purchase it in a trust because you can purchase real estate transactions, transfer the interests of a transaction, basically the ownership, without accelerating the due on sales clause in almost every, in the nation. Yeah, but again, check with your attorney, but in every nation. So basically, want to make sure they're getting paid every month and not concerned as much about the due on sales. But also, if you put it in a trust, it's a non-issue. There it is. I said it right there. Also, getting foreclosed on if payments are not maintained. That is definitely a risk. This property is still, or the lien is still in your name and you're responsible for it. And it's why it's also recommended to use a third-party note servicer because if you can see when and if the payments are made, and this note servicer can go ahead and start foreclosing on the buyer so that you can actually get the deed back and all the added value and the pay down that's been made, property essentially back in your name and you back to sort of the starting board, but hopefully with an even better property. And some are concerned about qualifying for loans. What if you want to go and maybe purchase another home or a car? How does this affect your debt to income ratio? Well, essentially, you will fill out the income verification form that's almost on every application when you have assets or have other assets, I would say. And you show that this property actually is generating income. It's being paid off. It's almost as if you were like the investor itself and you have a renter, but instead of the money going to you, the money's going to the mortgage, the lender. So, and that will offset your debt to income. I believe the first 9 months it offsets for 75%. And then after that, it's 100% that it offsets. So that impact is minimized for the first 9 months, and then it's a non-issue after that when you show steady payment. So if you're interested in learning more, I am focused on helping folks through the probate process. And one aspect of that, again, is figuring out what are some real property, some solutions to some of the challenges that we face when we have property. If you're fortunate enough not to be going through probate, that's great. And still can support and help you if you have property or something that you may be interested in thinking about what can we do here. All right. So that's it for me right now. Love for you to hit the like, subscribe, and yeah, rising tides, let your light shine.